For 60 years after the New York Stock Exchange opened its doors under a buttonwood tree on Wall Street, a company could sell shares to the public without disclosing a single audited fact about its finances. No balance sheet, no earnings statement. No requirement that the numbers printed in a prospectus bear any relationship to reality. A man could buy stock in a firm on the strength of a rumor passed along a brokerage floor, and the law offered him nothing beyond the old warning that a buyer should look out for himself. This was not a flaw in the system, it was the system. The exchange itself was a private club, governed by its own members, answerable to no federal authority, and for most of American history that arrangement was treated as a point of pride rather than a danger. The men who ran it insisted that Wall Street policed itself better than any government agency ever could, and for decades almost nobody in Washington was willing to argue otherwise. Then came October of 1929, and the years that followed forced open a set of practices that had been sitting in plain sight the entire time, tolerated not because they were hidden, but because no statute existed to call them anything other than business as usual. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. State legislatures had not ignored the problem entirely. Kansas passed the first so-called Blue Sky Law in 1911, aimed at stopping promoters from selling stock in companies that amounted to nothing more than a claim on the open sky, and by the 1920s, most states had some version of a securities statute on their books. New York's own version, known as the Martin Act, dated to 1921 and gave the state attorney general broad power to pursue securities fraud within its borders. But these laws were built for intrastate swindles, small-time promoters selling worthless mining claims to their own neighbors, and they had no answer for a national market in which a broker in Chicago sold shares in a company incorporated in Delaware to a customer in Ohio over a telegraph wire. A prospectus that violated Kansas law could still be mailed lawfully into a dozen other states. The gap between what states could reach and what the market had actually become was where the practices this story is about were allowed to operate freely, in full view, for years. By the middle of the 1920s, buying stock had stopped being a habit confined to bankers and inherited wealth. Brokerage offices opened in hotel lobbies and department stores. Radio stations broadcast closing prices alongside the evening news. Estimates from the period put the number of Americans with some form of stock market exposure, whether through direct ownership or margin accounts, somewhere in the range of 9 to 10 million people, a figure that had been a small fraction of that only a decade earlier. This was the audience the absence of disclosure law was actually operating on, millions of new participants with no professional training and no legal guarantee that the company whose stock they were buying had told them the truth about anything. A separate, older kind of operation had already been pushed to the margins of respectable finance by the 1920s, but had not disappeared entirely: the bucket shop, a storefront where a customer could place a bet on whether a stock's price would rise or fall without ever actually buying a share, wagering directly against the house that ran the shop. The exchange itself had spent decades trying to shut these operations down by refusing to supply them with live price quotations, and most states had outlawed them outright by the time of the crash. But the bucket shop's basic premise, that a person could speculate on the direction of a stock's price with no real ownership standing behind the bet, survived in a more respectable form inside the margin accounts the major brokerage houses themselves offered, where 10% down bought exposure to the full value of a stock an investor never intended to hold for long. To understand how deep the absence of rules actually ran, you have to understand what the New York Stock Exchange was in the 1920s. It was not a public institution in any meaningful sense, despite trading the shares of the largest public companies in the country. It was a members-only association, and a seat on the exchange, the right to trade on its floor, was itself a piece of private property that changed hands for hundreds of thousands of dollars. The man who presided over that association for most of the crash years, and the years immediately after, was Richard Whitney, a Boston-bred broker with a Harvard pedigree and a personal account at J.P. Morgan and Company, the most powerful private bank in the country. Whitney became president of the exchange in 1930, and for the next 5 years he was the single most visible defender of the idea that Wall Street needed no outside supervision at all. He testified before Congress. He gave speeches to bankers' associations. He told anyone who would listen that the exchange's own rules, enforced by its own members, were sufficient protection for the investing public, and that federal regulation would strangle the very market that financed American industry. What Whitney's version of self-regulation actually permitted is where the story gets its shape. There was no law against a corporate insider trading on information the public did not have. If a bank director learned on a Tuesday that his company's earnings were about to collapse, nothing prevented him from selling his own shares on Wednesday, before the figures were released, while his own brokerage continued recommending the stock to ordinary customers. There was no law requiring a company to publish audited financial statements before selling shares to the public, which meant a prospectus could contain whatever the underwriter chose to put in it. There was no restriction on margin lending, so investors were routinely buying stock with as little as 10% down, borrowing the rest from brokers who were themselves borrowing from banks, building a tower of debt on top of paper values that could evaporate in an afternoon. And there was no restriction on a small group of wealthy operators coordinating their trades to manufacture the appearance of demand in a stock, a practice that had a name on the floor of the exchange, the pool. There was a quieter form of built-in advantage as well, one that never required a syndicate at all. Every stock traded on the exchange floor through a specialist, a member firm assigned to handle orders in that particular stock, and to maintain the book that recorded every buy and sell order waiting to be filled at prices above and below the current market. That book was private. Only the specialist could see it, which meant the specialist alone knew exactly where the pressure was building on either side of the market before anyone else did, and nothing in the rules of the exchange prevented the specialist from trading for his own account on the strength of what that book showed him. It was not called insider trading because the term barely existed yet in anything like its modern legal sense. It was simply understood as one of the privileges that came with holding a seat. The pool was not a rumor or an urban legend. It was an organized, openly discussed business arrangement, and one of its most accomplished practitioners was a broker named Michael J. Meehan, who specialized in the shares of the Radio Corporation of America, known to every investor of the period simply as RCA. In March of 1929, Meehan assembled a syndicate that included figures such as John Jacob Raskob, the General Motors executive who also chaired the Democratic National Committee, and Walter Chrysler, the automobile manufacturer. Together they pooled several $1,000,000 and began buying and selling RCA stock among themselves in a coordinated sequence of trades, driving the reported volume and the price upward day after day. To an outside investor watching the ticker, it looked exactly like what it was designed to look like, a stock that the smart money wanted. The public piled in behind the pool, buying at rising prices, and once the pool's own members judged the moment right, they sold their shares into that public demand and walked away with the profit. RCA's stock had gained roughly 50 points across the life of that one operation. None of it was illegal, all of it was legal, because there was no law on the books that made it otherwise. Meehan's operation in RCA was not an isolated scheme. When the Senate investigation later reconstructed the record, it found that something on the order of 100 organized pools had operated on the New York Stock Exchange during 1929 alone, running the same basic playbook across dozens of different stocks. The techniques had names of their own inside the trade. A wash sale involved a pool member selling shares to another member of the same pool, creating a trade that showed up on the ticker as genuine volume without any real change in ownership. A matched order paired a buy order and a sell order, placed at nearly the same moment and the same price by parties acting in concert, producing the same illusion of active, independent trading. Some pools worked the mechanism in reverse, spreading pessimistic rumors about a company while selling borrowed shares short, then buying them back once the manufactured panic had driven the price down, a maneuver traders called a bear raid. None of these techniques required deceiving a regulator because there was no regulator positioned to notice them. They only required deceiving the public, and the public had no way of knowing which trades on the ticker tape represented real demand and which represented a small group of insiders trading with themselves. Pool operators reinforced the illusion of independent demand with a second, cheaper tool, the financial press itself. It was common practice for a pool to pay a market columnist or the writer of one of the widely circulated tipster sheets a fee, timed to coincide with the pool's own buying, to publish an item praising the stock's prospects just as the coordinated purchases were pushing its price upward on the ticker. A reader following the financial pages had no way to distinguish a columnist's independent judgment from a column that had, in effect, been purchased as part of the same operation driving the price he was reading about. The later Senate investigation confirmed that this arrangement extended into some of the era's most widely read financial commentary, which meant the manufactured demand on the ticker tape and the manufactured enthusiasm in the morning newspaper were, in a meaningful number of cases, coming from the same source. By the autumn of 1929, margin debt on the New York Stock Exchange had climbed past $8 billion, an enormous sum for an economy the size of the United States at the time, and almost all of it was collateralized by stock, whose price depended on the same buying enthusiasm the pools had helped manufacture. On October 24th, the day that came to be remembered as Black Thursday, panic selling briefly overwhelmed the floor, and a group of the country's most powerful bankers, led by Thomas Lamont of J.P. Morgan and Company, met that afternoon and pooled their own funds in a public show of confidence, buying blocks of stock at above-market prices to try to steady the tape. It worked for exactly 4 trading days. When Black Monday and Black Tuesday arrived at the end of the following week, no banking consortium stepped forward to repeat the gesture, and the market fell without a floor beneath it. The stock market's paper value fell by roughly $30 billion across those 2 trading days alone, a sum that dwarfed the entire cost of American participation in the First World War, and the country entered a depression that would not meaningfully lift for a decade. The crash alone did not force reform. What forced reform was a second collapse, one that unfolded more slowly and revealed something the market crash had only hinted at, that the men running some of the country's largest financial structures had built them on foundations that could not survive daylight. The clearest case was Samuel Insull, a Chicago utility magnate who had built an empire of holding companies stacked on top of each other, each one owning shares in the one below it, each layer borrowing against the value of the layer beneath. The structure ran through 3 principal tiers: Middle West Utilities at the base, Insull Utility Investments above it, and Corporation Securities Company of Chicago at the top, so that a small decline in the earnings of the operating utilities at the bottom was magnified many times over by the time its effect reached the top of the pyramid. At its peak, the combined paper value of Insull's holding companies had reached something on the order of $3 billion, controlling electricity and gas utilities, serving some 6,000 communities across 32 states, and hundreds of thousands of small investors, many of them the utility's own customers and employees, had bought stock in the holding companies believing they were buying into stable, regulated power businesses. What they had actually bought was equity in a pyramid, and when the base of that pyramid weakened in 1932, the entire structure came down in weeks. Insull fled the country ahead of criminal charges, sailing first to France and then to Greece, which had no extradition treaty with the United States at the time, before Greek authorities eventually pressured him to leave, and he was detained in Turkey and returned to Chicago to stand trial for fraud. A jury acquitted him, in part because nothing he had done was clearly illegal under the law as it existed. The prosecutors could show recklessness. They could not show a statute he had broken. Insull's collapse produced its own dedicated piece of legislation, separate from the 2 Securities Acts, once Congress had finished tracing exactly how the pyramid had been built. The Public Utility Holding Company Act of 1935 placed direct federal limits on the layered holding company structure Insull had used, restricting how many tiers a utility empire could stack on top of its operating companies and giving regulators the power to force the more extreme pyramids to simplify or dissolve. The law was written with Insull's own corporate chart open on the drafters' desks, and utility executives fought it in court for years, but the structure that had led a decline in a power plant's earnings in Ohio, wipe out a shareholder in Massachusetts, several layers removed from that plant, was, after 1935, no longer legal to build in the first place. That gap between what had ruined ordinary families and what the law actually prohibited became the subject of a Senate investigation that began in January of 1933 under the Senate Banking and Currency Committee. The investigation had been underway for months without much public notice until the committee hired a new chief counsel, a former Manhattan assistant district attorney named Ferdinand Pecora. Pecora had spent years prosecuting stock fraud cases in New York courtrooms, and he approached the Senate hearings the way he had approached criminal trials, building his questions around documents rather than accusations, and the hearings that followed would come to be known simply as the Pecora hearings, even though Pecora himself held no official title beyond counsel to the committee. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. Pecora's first major target was Charles E. Mitchell, the chairman of National City Bank, the institution that would later become Citibank. Mitchell had a public reputation as a booster of the market, a man who had once helped organize a bankers' pool during the 1929 panic, specifically to prop up prices and reassure the public, earning him the nickname Sunshine Charlie in the financial press. Under Pecora's questioning in February of 1933, a very different picture emerged. National City Bank operated a securities affiliate, the National City Company, which had spent years selling bonds from Latin American governments, including a series of Peruvian bonds, to retail customers across the country. Pecora produced internal bank correspondence showing that National City's own officers privately doubted the creditworthiness of some of these bonds, even as their salesmen continued marketing them to individual investors as sound, income-producing investments. Pecora also established that as the market began to weaken in late 1929, Mitchell had sold a large block of his own National City stock to his wife at a loss, a transaction that produced a tax deduction for Mitchell personally, while the underlying shares never actually left the family's control. Mitchell was indicted for tax evasion. A jury acquitted him of the criminal charge, but he settled a civil suit with the government for a sum reported at more than $1 million, and he resigned from the bank within days of his testimony, as depositors lined up at National City branches in numbers large enough that bank officers spent the following week publicly reassuring customers that the institution itself remained sound, even as its former chairman faced a grand jury. Mitchell was not the only bank chairman whose personal trading the hearings brought into the light. Albert Wiggin, the chairman of Chase National Bank, testified that in the weeks surrounding the crash, he had personally sold short several 100,000 shares of his own bank's stock through a set of family holding companies, a bet that Chase shares would fall, placed by the man whose public statements were meant to reassure Chase's own shareholders that the bank was sound. The short position earned Wiggin several $1 million in profit, at the very moment ordinary Chase shareholders were absorbing the losses on the other side of that same trade. It was, like Mitchell's arrangement with his wife, entirely legal. There was no rule anywhere in American law preventing a bank's own chairman from betting against the institution he ran. Pecora then turned his questions toward J. P. Morgan and Company itself, and testimony from the firm's partners revealed the existence of what became known as the preferred list, a roster of prominent individuals who had been offered shares in new stock offerings at prices well below what the general public would pay once the shares began trading, all but guaranteeing them an immediate profit the moment the stock opened. The list that emerged in testimony included men who held no formal connection to the bank's ordinary business at all, among them the former President of the United States, Calvin Coolidge, who had left office in 1929. There was no law against a private bank offering discounted shares to whomever it chose. The revelation was damaging precisely because it was legal, a demonstration that access to the ordinary terms of the market had never been equal to begin with, and that the firms most trusted to guard the market's integrity were, by their own admission under oath, running one set of terms for the public and a considerably better one for their friends. Richard Whitney testified in the same hearings, still defending the position that the exchange's private disciplinary rules were sufficient, that outside regulation would only drive capital away from productive investment. The committee had, by that point, already documented pool operations, undisclosed insider selling, a bank chairman shorting his own institution's stock, bond salesmen pushing bonds their own bank considered doubtful, and a holding company structure that had erased the savings of hundreds of thousands of families without anyone breaking a law. Congress did not need to prove that Wall Street was uniquely corrupt. It needed only to show that the absence of any disclosure requirement, any restriction on insider trading, and any oversight of the exchanges had made every one of these outcomes not just possible but, in the environment of the late 1920s, close to inevitable. The legislative response came in two parts. The Securities Act of 1933 required for the first time in American history that companies issuing new stock to the public register with a federal authority and disclose meaningful financial information, including audited statements, before a single share could be sold. It was built on a simple idea that had never before been law, that an investor was entitled to the truth about what he was buying. The following year, the Securities Exchange Act of 1934 went further, extending disclosure requirements to companies already trading on the exchanges through periodic reports, giving federal regulators the power to set margin requirements instead of leaving them to the brokers who profited from lending, forcing corporate insiders to return any profit earned on shares of their own company bought and sold within a 6-month window, regulating for the first time how companies could solicit shareholder votes through proxy statements, and explicitly outlawing the kind of coordinated wash sales and matched orders that had driven RCA's stock upward in the spring of 1929. The act also created a new federal agency to enforce all of it, the Securities and Exchange Commission, and gave that commission authority the New York Stock Exchange itself would now have to answer to, ending, on paper at least, more than a century of the exchange regulating only itself. The two acts had not written themselves. A group of young lawyers working under Roosevelt's law professor turned advisor, Felix Frankfurter, drafted much of the text, chief among them James Landis, Benjamin Cohen, and Thomas Corcoran, none of whom had held a job on Wall Street, which was precisely the point of choosing them. What happened next is the detail most retellings of this story leave out, and it is the detail that gives the whole episode its real shape. President Franklin Roosevelt had to select someone to chair the new commission, someone who would define, in practice, what this untested federal power would actually do. His choice was Joseph P. Kennedy, a Boston financier who had spent much of the previous decade doing precisely the things the new law now prohibited. Kennedy had participated in stock pools himself, including a coordinated operation in the shares of Libby Owens Ford Glass Company in the months before the reform took effect, buying and selling in concert with other large holders to move the price and profit from the public's response. He understood the mechanics of manipulation from the inside because he had practiced them. When Roosevelt's advisors objected to the appointment, the president is reported to have answered that it took a poacher to catch a poacher, that a man who already knew every method the operators used to work around a rule would be far harder to outmaneuver than a career regulator encountering those methods for the first time. The exact wording of that exchange has never been documented in Roosevelt's own papers with full certainty, and it may have been polished in the retelling over the decades, but the appointment itself is not in dispute, and neither is Kennedy's record as a market operator before he took the job of policing the market. Kennedy served as the first chairman of the Securities and Exchange Commission for roughly a year, and by most contemporary and later accounts he ran the agency with real seriousness, building its enforcement staff, establishing the registration procedures the 1933 and 1934 Acts required, and giving the new commission enough credibility in its first months that it survived the skepticism of a financial industry that fully expected it to collapse under its own inexperience. James Landis succeeded him as chairman in 1935, bringing a regulator's temperament to an agency Kennedy had spent his first year defending as much as building. The man Wall Street had once counted as one of its more aggressive operators spent his year in Washington building the machinery that would, over the following decades, make the kind of pool he had once run in Libby Owens Ford stock a federal crime rather than an afternoon's work. Michael Meehan, the broker who had assembled the RCA pool in the spring of 1929, discovered exactly how much the ground had shifted within a few years of the Commission's founding. When he was barred from membership in the New York Stock Exchange for manipulating the stock of an aircraft company, becoming one of the first brokers the new federal machinery removed from the market entirely, rather than merely fined or reprimanded by his own club of fellow members. Whitney's story ended differently, and it ended after the reforms he had spent years opposing were already law. He left the exchange presidency in 1935, still a respected figure in New York financial circles, still trading on the credibility of the Whitney name and his connections at Morgan. His own brother, George Whitney, was a partner at J&P Morgan and Company, and it was to George and to other Morgan partners that Richard first turned when his private investments began failing, borrowing sums that were never made public at the time and that the firm extended privately, in the same spirit of gentleman's discretion that had once justified keeping the entire market free of outside supervision. The loans bought him years. They did not fix the underlying problem. What almost no one outside his immediate circle knew was that Whitney had been quietly losing money in a series of bad personal investments for years, and that once the Morgan loans were no longer enough, he had covered his shortfalls by taking, without authorization, securities that did not belong to him. He drew on the New York Stock Exchange Gratuity Fund, a pool of money set aside for the widows and children of deceased exchange members. He drew on funds belonging to the New York Yacht Club, where he served as treasurer. He took bonds that had been placed in trust for his own father-in-law's estate. When the scale of the missing money finally came to light in March of 1938, the exchange itself, the institution Whitney had spent years insisting could police its members without outside help, was forced to publicly expel him and refer the matter to the district attorney. He pleaded guilty to grand larceny and was sentenced to Sing Sing prison. The man who had told Congress that Wall Street did not need a federal watchdog because its own members would never tolerate this kind of conduct from one of their own turned out to have been stealing from a widow's fund the entire time he was making that argument, and it was the very Securities and Exchange Commission he had lobbied against that helped uncover the trail of missing securities that finally brought him down. There is a way to tell this story that ends simply, with corrupt men caught and a corrected system installed to guard against them going forward, and there is truth in that version. Investors buying stock today are entitled to audited financial statements that did not exist as a legal requirement before 1933. Insider trading on undisclosed information is a federal crime rather than an accepted professional advantage. Coordinated pool manipulation of the kind Meehan ran in RCA would draw an immediate enforcement action rather than admiring coverage in the financial press. The commission Kennedy built still exists, staffed now by thousands of lawyers and examiners, still built on the basic register and disclose framework the 1933 and 1934 Acts established, and still amended in the aftermath of later failures, the same way it was born out of the failures of 1929, through the Sarbanes-Oxley Act after the accounting scandals of the early 2000s, and the Dodd-Frank Act after the financial crisis of 2008. But the record also shows something less tidy than a clean before and after. The absence of rules before 1934 was not an oversight that nobody had thought to correct. It was a deliberate position, defended in Congress for years by the exchange's own president, on the theory that the market's participants could be trusted to discipline themselves. The men making that argument were, in several of the most prominent cases, either already engaged in the practices the argument was meant to protect, or would go on to be caught in conduct the argument had assured the public could never happen. The reform did not arrive because Wall Street recognized a problem and fixed it. It arrived because a Senate committee council spent months pulling internal bank records into public view until the gap between what self-regulation promised and what self-regulation had actually permitted became impossible to explain away, and because a president decided the man best equipped to close that gap was someone who had profited from it himself. The system investors rely on today was not designed in advance to prevent what happened in the 1920s. It was assembled afterward out of the wreckage by people who in more than one case had helped create the wreckage in the first place, and it has been amended and expanded in the decades since, precisely because the instinct to work around whatever rule exists did not disappear the day the Securities and Exchange Commission opened its doors. It simply lost the legal cover it had enjoyed for the better part of a century. The men whose names run through this record, Whitney defending the club that expelled him, Kennedy building the cage after years of testing its bars, Meehan learning what his own methods now cost, were not villains operating outside the system of their time. They were the system, functioning exactly as it had been built to function, until enough of its own paperwork ended up in a Senate hearing room for the public to see what the absence of a rule had always actually meant. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.